In this presentation, we will take a look at financial statement analysis tools and data that can be found online. As we go through our ratios and other tools for financial statement analysis, it's important for us to understand those ratios so that we can interpret those ratios and calculate those ratios. It's also important to note, however, that there are many tools that can help us to calculate the ratios and even do some work in terms of the interpretation of those ratios. And there's also going to be industry data that we can find. There's going to be resources that actually compile industry data. Some of these will be privately held resources that you would have to pay for to get this data that's going to be comparing our information to industry standards. And you can find some resources that will be free that basically compile the industry standards. That's one of the major things that we would like to do with our data is say, how does our data line up to industry standards? Software can help us to do that because they can help us to calculate our actual ratios. It can calculate the ratios for the industry that is related to us, and it can do comparisons much more easily in that format. We're going to be taking a look at this URL website to see some resources that you can find for free online. We're currently at a University of Denver page. If we scroll down, we're at the company research industry analysis. We have the tools down here. We have some resources. So they've got some links to some resources. We're going to take a look now at the Biz Stats. So we're going to go to the Biz Stats. As we do so, you can see the URL up top, www.bizstats.com, bizstats.com. We scroll down and we see we have the free business statistics and financial ratios. BizStats is the home of free, accurate business statistics. We're going to look here to research for industry financial benchmark reports. That's what we want to do. We want to basically compare what we have to the benchmark type of reports per industry, the industry in essence standards. And the way to do that is, of course, a compilation of the data, the compiled data, then we can basically compare to the standards with that information. We've got the corporations, we've got the sole proprietor, we can search by annual sales. We're going to go into the corporations. We can take a look at the industries. I'm just going to pick an industry. I'm going to pick construction as the industry. We continue further into construction. I'm going to say construction of buildings. And then we're going to go to the construction of buildings data. And we can see that we're going to get some of the industry data. Again, this is going to be the compilation of data. We've got 2013 construction of buildings data information here. So you can go through this information and take a look at how it is compiled. Note that when we take a look at industry standards, there's a lot of different ways we can compile the data, of course. So, and the different ways that we compile the data, who we include in the industry standards and who is excluded, or how specific the companies that we are including are, or how broad versus how restricted the categories we are using, are all going to be big effects on the industry standards. So when you think about industry standards, it's not something that's very cut and dry because we're taking the average of many different industries and we can cut that average up into different ways depending on how we categorize that average. So note that the ratios themselves, we have fairly standardized types of ratios. When we calculate our own ratios, we're going to have fairly standardized types of calculations that are going to be standards that are used. When we think about comparing them to another company, one single company, then, of course, if we can get their company ratio data, that's going to be fairly straightforward. We can benchmark to a single company. When we benchmark, however, to an industry, note that's not so straightforward because we're doing some type of averaging process through the industry. And the way we average the types of companies that are going to be involved is going to have a big impact on the average that will result from it.